Hello, students and viewers. This is Mr. Williams of Upelcom College. Our contacts are here, Mr. William and Mr. Steve. Today, we are discussing about VAT, a paper which is applicable in public finance and taxation, ATD 3, that is Accounting Technician Certificate, which is examined by CASNEB in Kenya, and also CPA Section 6, Advanced Public Finance and Taxation, CASNEB in Kenya. Now, today we are going to discuss about VAT, that is Value Added Tax. Now, let's have a brief history about VAT, the Value Added Tax. Now, VAT was introduced in Kenya in the year 1990 to replace the sales tax, which was in force from the year 1973 to 1989. Now, when you are preparing the VAT account, there are two things that you are supposed to note here, two or few things for that matter. Number one is that VAT is an expense to the business. Therefore, when you are preparing the VAT account, you are supposed to remember all the accounting principles which applies when you are preparing the expenses accounts, that is, expenses have a debit balance. Now, let's move straight away to the preparation of the VAT account. Now, here we have the format for the VAT account. You can see on the debit side, we have the input VAT, and on the credit side, we have the output VAT. Now, note this, that the input VAT is computed on purchases and expenses, and output VAT is computed on the sales alone. Now, the other thing that we have to note when we are preparing the VAT account is that you may be told that these transactions were exclusive of VAT. So, in any case you have been told that the transactions are exclusive of VAT, that is exclusive, now you have to compute your VAT this way: 16 over 100 times the amount given, that is if the transactions are exclusive of VAT. Now, other times you may be told transactions are inclusive of VAT. Inclusive of VAT, you will compute your VAT this way: 16 over 116 times amount. Now, in Kenya, we use 16% because different countries have different taxation rates. Now, the 16% is applicable in Kenya. So, if you are using 16% and you are told the transactions were inclusive of VAT, to compute the VAT, the amount payable, then you have to use this formula: 16 over 116 times the amount given. Now, most of these computations you can still get them from our other lessons, but let's move straight away to the discussion of our topic today, that is the preparation of the VAT account. Now, we look at the debit side. What will appear on the debit side? Now, the first item is credit note to the debtor. What is a credit note? When do you issue a credit note? Now, you issue a credit note to the debtor. Remember, this debtor is like the purchaser, the customer. You issue credit note if there is an overcharge. If you overcharged a customer, then you have to issue a credit note. Number two, on the debit side, is the debit note from the supplier. Now, what is a debit note? A debit note is issued where there is an undercharge. So, this is coming from the supplier. We are saying debit note from the supplier. It is the supplier who has issued you with a debit note and he is telling you that we undercharged. Number three is the return inwards. Now, these are the sales which were meant to the customers, but the customer has returned. So where you have the return inwards, you debit the figure, then you have bad debts relief. If you have sold some goods to the customer and then maybe the customer is not able to pay for these goods, then these are referred to as the bad debts. In most of the cases, you end up writing off these bad debts because you may sell goods to the customer and then the customer passes away or the customer is mentally incapacitated. So for that reason, there is no way legally that you can get you can recover this amount. So you have to write off that customer as a bad debt. In that situation, you debit the figure. And then next is the bankruptcy. If the customer is bankrupt or is insolvent, then you debit the figure. The other item is over declaration of VAT, will be on the debit side. Then you have an error here. In financial accounting, you must have done the errors, that is financial accounting 1. We have those errors affecting the balancing of the trade balance and errors not affecting the balancing of the trade balance. Now you have, for example, the errors of commission, errors of omission, errors of original entry, transposition errors. You have several errors in financial accounting. Now, those errors, depending on how it is affecting the VAT account, you correct that error by posting the figure on the debit side of the VAT account. Now, let's stop at this point because the VAT payable becomes the balancing figure. Normally, the VAT account will not have a balance drawdown or balance carry down. Now, if we move on to the credit side, we have the output VAT. We have the output VAT. Now, with the output VAT, as we have said by the start of the lesson, output VAT is for sales. Now, the first item that you have on the credit side, and we are not saying the first item so that it means that it's always the first. You can start with any of this. But we are saying in our discussion, we have debit note to the debtor. Now, you can see here that we have a debit note from the supplier. Here we are saying debit note to the debtor. And we said a debit note means that the transaction was understated. So we are saying debit note to the debtor. This was a customer. You sold, you are the one who is writing this debit note to the customer. You are telling the customer, we undercharged the transaction. Now the next item is credit note from the supplier. Now on this side we are saying credit note to the debtor. Here we are saying the credit note from the supplier. Now the other item we return outwards. Return outwards. Now these are customers who purchased goods from your business. Now you are the one, this case is you are the one who has purchased goods from the supplier and then you return the goods to the same supplier. These are the return outwards. It's the opposite of the return inwards. You can see they are on the opposite side. Return inwards is on the debit side and then return outwards is on the credit side. Now we have the next item on the credit side of our VAT account is under declared VAT. You can see on the debit side we have over declared VAT. Here we have under declared VAT on the credit side. And then we have the errors here again. Depends on how the error is affecting the VAT account. Now there are those errors whereby you have them on the debit side and then there are others you have on the credit side. Now finally, after you have posted all these transactions there, you will have the balancing figure. If the difference is on the debit side, that will be the VAT payable. That is what you are supposed to pay to the government. Sometimes the difference may be on the credit side. If the difference is on the credit side, then that is a VAT claimable or refundable. In that situation, you will not pay VAT. but it will reduce the amount that you pay in the future. Normally, the government will not give you a cash refund. But in the future, if you are to pay tax, the VAT, and in the previous periods you were having a negative figure, it means you will have to pay a lesser figure. So that is how we prepare VAT account. And that marks the end of our lesson today. Remember, we are based in Dhaka. You can visit us in Vit Academy. We meet next lesson. Thank you.